Welcome back to the Neuro Finance Masterclass. Today, we've got an explainer that's going to fundamentally rewire how you look at the economy, how you view risk, and most importantly, how you handle debt. We're diving into a concept that truly separates the financial elite from everyone else. We're talking about inflationary leverage and exactly how to melt your debt, completely legally. You know we had to kick things off with the official motto. Now, to really grasp today's strategy, I need you to cast your mind back to day 67 of our journey. Remember our serious talk about the invisible thief? We broke down exactly how inflation quietly and relentlessly destroys the purchasing power of your hard-earned cash while you're asleep. Most people are completely terrified of this thief. But today, we're not hiding. We're looking at the exact, mind-blowing strategy the wealthy use to absolutely weaponize that inflation. Section 1. Capturing the invisible thief. Tying the thief to a plow. Tying it to a plow is the perfect metaphor here. Look, in high inflation environments, the wealthy, the real financial architects, they don't panic. They aren't hoarding cash under a mattress. Instead, they capture inflation, throw a yoke around its neck, and literally force it to work for their empire. They use the very economic forces that are bankrupting the middle class to legally melt their own debts away. Look at the loser in this economic game. This is the individual paralyzed by fear, acting as a coward, desperately holding on to fiat cash as inflation just eats it alive. They're guaranteed victim. But then you have the architect. The architect takes what we discussed back on day 84 regarding good debt, and they deliberately go out and lock in fixed-rate good debt to purchase productive assets. They are actively harnessing the chaos of rising prices to their absolute advantage. Which brings us to Section 2, the melting debt phenomenon, mathematical arbitrage. This phenomenon isn't magic, folks. It's pure, beautiful mathematical arbitrage. This is the core mechanism of inflationary leverage. Once you understand how this math fundamentally alters the weight of fixed-rate loans, your entire perspective on borrowing money is going to shift permanently. Let's break down the core scenario with a simple, concrete number, $100,000. When you take out a loan and secure a fixed interest rate, the principal amount you owe is locked in, nominally, forever. If you borrow $100,000 today, the contract says you owe exactly $100,000 10 years from now. The bank doesn't care what bread costs. The bank doesn't care what gasoline costs. That nominal number on the paper is completely frozen in time. So imagine a scenario where inflation runs incredibly hot, say at 50%. Because your debt is fixed at that initial $100,000 nominal value, the real value, the actual purchasing power of the debt you owe, drops by half in an incredibly short period of time. It's mind-blowing when you really think about it. Meanwhile, your income and the prices of real goods are adjusting upward. Inflation is literally stepping in and doing the heavy lifting of eroding your debt for you. It's exactly like having a silent business partner whose only job is paying off your liabilities. All right, Section 3, the hard asset mirror. The double win. Now we must pause for a grave warning here. You cannot just borrow money and leave it sitting in a checking account. Letting borrowed cash sit idle in an inflationary storm is what we call double suicide. You'd literally be paying interest on an asset that is simultaneously losing its purchasing power, total financial destruction. To activate this strategy safely, you absolutely must execute an immediate conversion into what we call productive assets. You have to mirror the debt with hard assets. We're talking about the ultimate safe havens we've covered earlier in this masterclass. High-quality stocks, which we obsessed over on day 70. Gold, our major focus on day 65, and of course, real estate. These are scarce, they produce value, and their nominal price tags rise directly with the tide of inflation. Here is the dual action effect in full swing. On one side of the equation, inflation is aggressively shrinking the real value of your fixed debt. It's literally melting the burden away. And on the other side, that exact same inflation is pumping up and exploding the nominal price of your hard assets. You are winning on both sides of the mathematical equation simultaneously. Your asset value goes to the moon, and the real weight of your debt crashes to the floor. It is a spectacular wealth-generating engine. Moving to Section 4, the variable rate trap, a warning for architects. To execute everything we just talked about, you need immense discipline. This is a game played exclusively by elite architects with high neurofitness because the margin for error is absolute zero. One wrong move, and this strategy will completely destroy your portfolio. And that brings us to the trap that catches all the amateurs, the variable rate liquidity trap. This is a fatal financial scenario. This entire strategy of melting debt only works if your debt is locked at a fixed interest rate. If you take out a variable rate loan, you're handing the bank the power to change the rules of the game while you're playing it. As inflation rises, central and commercial banks will adjust interest rates upward. Elite architects never, ever gamble with variable rates during an inflationary storm. Let's walk through this deadly four-step progression so you can see exactly how the math turns against an unprepared investor. Step 1. The bank issues a variable loan, often with an attractive teaser rate just to lure you in. Step 2. Inflation spikes in the broader economy. Step 3. To combat that inflation, the bank adjusts your interest rate drastically upward. And Step 4. The borrower is absolutely crushed under exploding monthly payments they can no longer afford. The asset they bought is liquidated at a massive loss. Do not fall into this trap. Fixed rates only. Finally, Section 5, the architect's master calculation, activating the strategy. So how do we put this all into practice safely? This brings us to your cognitive task for today. Activating this strategy requires you to sit down and analyze your economy's current true inflation rate and compare it against the available fixed-rate options out there. Whether that's business credit, 30-year mortgages, or fixed corporate loans, you must run the numbers. Here is the ultimate equation you need to burn into your mind. Take the nominal interest rate, right? That's the sticker price of the loan from the bank. Now subtract the true inflation rate of the economy. The result is your real interest rate. And here is the mind-blowing conclusion. If that resulting number is negative, listen to me very carefully. The financial system is mathematically paying you to borrow their money to buy your assets. And that leaves us with the ultimate question for today's explainer. Will you be the victim of rising prices, complaining as your cash loses its power? Or will you be the architect, the owner of the assets that cause those prices to rise? It is time to stop acting like a victim of the economy. Calculate your risk, build your empire with fixed leverage, and rule the cycle. See you in the next one.